What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is April 28th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are, and in today's video, I want to filter out the noise. I've been hearing lots of conversation out there in the crypto space about whether or not we're in a bull market or in a bear market, and quite frankly, I'm not one for labels. I want to spend some time today to talk about what you guys need to know, and that is the question as to whether or not Bitcoin is going to be going up here anytime soon, or if we have lower to go in regards to price. I'm going to be filtering out the noise, sharing the signal here, and telling you all what's really happening on the grand scheme of things. I'm finally back home here in Europe. I'm excited to dive into the video, guys, so let's go ahead and kick things off. Now, as you all know, most people are focused on the noise right now, and it's not meant to be an insult because to be completely frank, I think all of us are guilty of this in one way or other. We love to share our opinion on where things are going, and depending on how you define a bull market or a bear market, you're going to probably have a very different opinion than other people. If you define a bull market as Bitcoin chartering up over 10, 20, 30% month over month, making the kind of returns you'd expect hopefully in the S&P 500 on a good year, on an annualized basis, then yeah, Bitcoin may not be in a bull market. But if you're someone who focuses on higher lows and higher highs like I do, then you would definitely say that Bitcoin was in a bull market and not a bear market. But to be completely frank, the traditional bear market definition, I think this is where most of the distraction is really coming, is by a 20% correction in traditional markets. And I think we would all agree that a Bitcoin bear market is not a 20% correction, because if that's the case, then we've got lots of mini bull markets and bear markets that Bitcoin is going through just within the past year. And to be completely frank with you guys, it just doesn't apply here. Bitcoin is a much smaller market. Same with crypto as a whole versus equities, bonds, you name it. And they have much longer term cycles, those markets, than crypto does in this case, in the grand scheme of things. Whereas Bitcoin bull markets can be just a matter of anywhere from a year to a couple years. In the case of traditional markets, they can be a decade or multiple decades. Same goes for their bear markets. They can be much more longly drawn out. Now, I don't want to go ahead and spend all this time talking about labels. If you guys are still here, I want to go ahead and dive into the continued noise here that people are focusing on. Well, everyone is constantly debating about, in this case, the upward moves in the market and the downward moves, making their arguments when the days are paving their way upward or downward in price. I want to go ahead and focus here on the really big picture. Now, you guys know, and I won't spend too much time talking about this, if you haven't seen my previous video where I made my video talking about the most important topic that I want you guys to be focusing on going into 2022, if you haven't seen that video, go check it out, pause this one, come back to it. But once you've watched that video, we talked about this concept of the US bond market, US treasuries starting to dive and go out of style effectively, meaning that the price of bonds is starting to drop dramatically. And therefore, the yield on those bonds, that government debt, is starting to spike higher. Now, if you guys remember from the previous video, we talked about how in this case, how generally there's an inverse relation here. As bond prices go down, yield should go up, right? It's like, again, in this case, the yield you'd expect from a savings account in this case. You're getting some kind of yield by holding on to that IOU note, just like how you deposit money into a bank to get some kind of yield. Well, at least you could back in the day. But all the while, this may seem very boring. This chart here holds more significance and more weight than any daily move or any bull market or bear market of crypto. And that's why, again, I want people to understand that you have to respect these kind of traditional boring systems. You have to understand the magnitude that comes with them, because when US bonds drop 10% in price, or more specifically, set in their multi-decade high here in March of 2020 during the peak of the pandemic and drop around 17.8% in their value from that peak point. This is something to pay attention to. It is a dramatic shift of trillions of dollars in perceived value from one narrative to another, one asset to another, okay? And I want to go ahead and talk about how this is going to play into crypto big time, because all I've been hearing about, and I'm actually going to reference an article here in a moment from Arthur Hayes that actually kind of makes the argument I want to talk about later on. Arthur Hayes was the founder of BitMEX, so he's quite a whale in the space. He's got a history in crypto. He was talking back a couple of weeks ago, and we chatted about it here on the channel, about the correlation here between crypto assets like Bitcoin and Ethereum versus major stock indices like the NASDAQ and the S&P 500. And you can see all these different charts here that show that kind of green positive correlation in this case between the two assets, right? But again, correlation isn't always causation. And all the while I appreciate Arthur's and many people bringing this up, I want to go ahead and talk about how we are on the verge of a breakaway between these two assets. Now, you all know I've brought up this chart a lot. I don't want to beat a dead horse here. I'm going to be building some really important information on top of this. But you guys know we come back to these charts to reiterate the point here that all the while the S&P 500 or the NASDAQ might have similar divergences or kind of moves in price to crypto assets. It is important to note, more important than not, to state that crypto is currently outpacing equities, and it has been doing it for nearly a year and a half now, since really the start of 2021, right? We can see here, back in December of 2020 here as we went into this year, we've continued to make higher lows here for the trend. It is still generally up here since back here in December against equities. And all the while during this period of time, equities have entered into what might look like the first substantial actual bear market, excluding the March 2020 dip, in over a decade, nearly 2 decades. We see crypto holding up fine and dandy against the S&P 500 and the NASDAQ, which weights the vast majority of market capitalization and value within equity markets. This is not just true for the BTC to NASDAQ ratio, it's also true for the S&P 500. We are still, since back here in December, up over 84%. Now, is it as good as where we were back here, for example, in October, or back here in March? No, of course not. We've had a dip in crypto markets, but all the while here, over the past few months, where we've started to see the S&P 500 starting to dip here since in December, or the NASDAQ and price starting to crater here, going from 16,000 on the indice to 12,400, setting in new lows that haven't been reached since back here in March of 2021 or back in December 2020. We're not seeing the same kind of price action for Bitcoin, right? You would expect that as during bull markets, where we might see the S&P 500 go up 20%, we'd expect Bitcoin to go up, 100, 200%. At the same time, we should expect that equities, when they go down 20%, Bitcoin is cratering. It's down 60, 70% in price, going through a full swing bear market, but that's just not how it works. And it certainly isn't working that way now. When we take a look here at the ratios, Bitcoin is making higher lows here against the equities market, no matter what index you're looking at here. Now, I want to talk a little bit about why this is happening here. And again, just to back it up here, as you all probably remember in our last video, we utilized the bookmap tool here to get an understanding here of what's really going on in the sense of price. Because I can understand if you guys are looking at the current market price, you're probably wondering, Nick, look, if crypto is really going to start soaring higher, which is what I really care about if I'm going to be investing in it, right? Why do you keep focusing in on these deep market insights here? We're clearly not seeing it in price right now. And if that's what you're concerned about, yes, I completely understand, guys. We are not seeing an absolute killer rebound yet in the crypto market. But I want to talk about why it's important to look deeper and not to focus on exactly what's happening now in the sense of the surface in price, but focus on what's going on behind the scenes. What's setting up right now that could lead towards a catalyst breakout in price, a serious move higher. And also we have to be cautious about what could be going on behind the scenes that could lead prices to go down. We want to make sure that we're not caught up on one narrative. But I want to show one key chart here. Now, if you guys haven't seen me use Bookmap before, Bookmap is a deep liquidity tool. It allows us to track not only historic data in the market and get insights on market price, deeper than just analyzing the price itself. But it allows us to gauge in a whole range of metrics, two of which are my favorite, are the core staples of the Bookmap platform. You've got the CVD, the cumulative volume delta, which is measuring market order flow. Are more people taking the best available price for Bitcoin to either buy or sell? And the second metric, which is what I want to focus and bring your attention to here today, is the order book. Now, it's one thing to look at one exchange order book. It's another to take a look here at multi-book. This is a unique feature on one of the paid plans on Bookmap here today. And if you guys are interested, you can get a discount at the link down below. I've got a discount code, 20% off your first month if you guys want to give it a shot. It's my favorite tool outside of TradingView. I use it myself to do market analysis, and I definitely recommend if you guys are an active trader or a more passive investor, it still can be incredibly valuable to get market insights. Now, I want to bring your attention here again to the cumulative order book here. This is taking in the exchanges of Kraken, FTX, Coinbase Pro, Bitfinex, Bitstamp, deep liquidity on the order book here. And I want you to tell me if you notice anything different here. This is the amount of Bitcoin at given designated points on the order book here. You can see that we're trading around $39,550 at the current market price. But as we go up here, these are individuals who are looking to sell their Bitcoin at a higher price. This is going to weigh down as resistance. Whereas down here, these are the bids on the order book. These are people looking to buy Bitcoin if market price were to drop down. If there was enough people looking to market order sell down at the existing best available price. Now, on the right-hand side, we can see the cumulative order book aggregate here, which is, as over time, expanding in both directions, growing. But do you notice anything different, significantly different, between the aggregate order book of the bids versus the asks? Not exactly, but it is nearly twice as big on the bid side versus the asks. A near 2-to-1 ratio between the two. This isn't just happening on one exchange like Coinbase or Binance, it's happening across the vast majority of exchanges. Folks, I can't emphasize it enough right now that what we're seeing here is a slow, steady, and quiet institutional handoff. Now, what do I mean by this? I effectively mean that we're seeing a changing of the guard right now. While whales are, in this case, selling their positions, not to mention as well, a lot of retail participants, a lot of people worried about the state of the market because it's not going up in absolutely parabolic fashion, what we're seeing here is that there are a lot of people hoping that through each of these sell-side events, it's going to be good enough to start stacking up some major positions on the order book. Great example of this, whereas you've got around 196 Bitcoin here being willing to be sold at the next major $10,000 interval behind 40K, right? Around $50,000. We can see here at $30,000, there's 356 Bitcoin worth of buy orders waiting to be filled at that range if market price goes to that range. Very big difference here, right? Again, major difference here between the sell side pressure, because if we clear through this kind of narrow window of time here on the order book, if we clear through this 132 Bitcoin here, really at the start here around this 40K range, if we clear through that, the sky's the limit. And that's exactly what we've been seeing here in regards to market price. Every single time we see Bitcoin kind of clear through the short-term resistance range, within a matter of a day or two, Bitcoin's price just really starts to get up towards this range here where it's next to chartering this 50K range, right? We've done this many times here where we have these kind of breakouts in price because there just isn't the resistance on the asks. There are no major players that are looking to sell at those ranges. So it's not important just to focus on what market price is doing now. It is important to focus on where the liquidity is setting up. Because those bids on the order book, those green, that green kind of mountain on the side of the chart, those are people who have cash on hand ready to buy Bitcoin. And all the while, the order book can change. It's important to watch it from time to time. There is a clear dynamic difference between the bids and the asks on the order book that is showing that there is a lot more silent optimism than silent fear in the market. People who have wanted to get out are either market selling right now during these pullbacks in price, getting rid of their positions, right? Or they're one of very few participants who are setting those asks on the order book. Most of the fear has been flushed out, as it usually is after a 50% plus correction, right? And we've already seen this since back in November in regards to Bitcoin's price, right? And the shocking reality is that really ever since equities have started to severely pull back, Bitcoin has been holding out neutral, and it's still making those higher lows over time. That's what interests me. And again, I want to go ahead and kind of bring up this point here. You know, we're not seeing major people selling. We aren't seeing it in the corporate treasurers that really drove the past Bitcoin rally. You'd expect them to be selling, but they're not. So this means we've got to expect that other people are selling in this case. Some other market participants, probably whales who are way overexposed and want to diversify their asset exposure. People who got lucky years ago, maybe nearly a decade ago on Bitcoin. They're changing the guard over towards a new group of investors who don't have any exposure to Bitcoin and want that exposure during a period of peak inflation, a period where equities are not looking very favorable, and most importantly, where bonds are not looking favorable. And that's what I want to get to here as we go throughout the conversation. You have people like Ray Dalio, who a lot of people admire in the crypto space and the broader market of investing. And I think Ray Dalio speaks in a very, very intelligent tone compared to a lot of Wall Street. He knows his stuff, he's humble, and he's going through the ranks of making many failures and successes along the way. But what I really like about Ray Dalio is that he's been able to maintain a relatively neutral opinion about crypto. Now, while he's still got his skepticisms, he's been one of many investors like Paul Tudor Jones and many other Wall Street tycoons that believe that 1% to 2% of your portfolio going to crypto is a reasonable bet. It's something that really not only is likely good in this case, but something that is going to become a future standard here, where there's that exposure to crypto. It's kind of a radical hedge against the massive system we have built over the past few years as the world has globalized, it's expanded GDP, right? And that is the US dollar, US treasuries, and other fiat currencies and government bonds. All right? Now, I'm not saying Ray Dalio is making that argument here that the bond market's going to go down or anything. I'm not making that argument. I want to be very clear about it. But the reason you hold a hedge like gold or a hedge like Bitcoin is because of the fact that it is a bet or a protection, an insurance policy, if you will, against the traditional system. Sure, you can see it as a purely speculative asset. To some, that's what it is. But Bitcoin is in this case, a completely separate asset from the world. There is no central bank that manages it. There are no changing rules. The rules are fixed. Similar to gold to some degree, right? Even though we don't know exactly how much gold is out there in the world, and there's 1% to 2% inflation every single year in your gold minting, right? We know with Bitcoin that it is programmed in. Same goes in this case for the network updates and the rules in this case for major networks like Ethereum. Right? We know in this case what the rules are. They're transparent. The ledger is transparent. You can't mint more coins than what is set to be able to be minted on chain. Now, if you ask me, this is a huge, solid bet against the bond market in the long run. But again, I want to just, talk here again about how we can see this in price. Back to those limit orders here, right? People are getting hungry. They want to get their limit orders filled, but they're not settling for the same price as last time. And there's also not as much people who are willing to drag market price down to those ranges until someone, in this case, starts taking dominance back in favor of the bulls and market order buying Bitcoin. That is why prices are going higher over time. There's no other way to tell it to you guys. I can't emphasize it enough here. The market price is telling us all we need to know here. During a period of fear in both the bond market and equities, crypto is making significant higher lows over both the short term and the long term over the last year to 2 years here. We can see it clearly within market price. We should see crypto piling downwards in price if it isn't being seen as a hedge here, if there aren't buyers who think this is a range where price should go higher. That's why, again, I think sooner rather than later, we are not only going to see another leg up here, right? We've had generally kind of 2 major legs up here in price, but I think we've got a chance to do a third one, and after that really start to charter higher in price. And I don't think it's going to be much longer from where we are here. Now, we've got one last final topic to talk about here, and this has to do with something that Arthur Hayes wrote about. I know I had mentioned I'm going to bring him up again. I think he writes some really incredible articles on the space, really interesting macro perspective, and I don't always agree with him, but I think that this is a really important point to think about here. Now, as we talked a lot about the bond market here, interestingly enough, just in this past day, Arthur Hayes put out a really interesting article kind of building on this topic that we've been discussing on the channel for the last couple of days, really over the last couple of weeks and months, and that is what he calls the doom loop. Now, he points out here that the United States and the EU and the major Western economies of the world have been selling government debt through one of various methods, much of which has been through selling debt or U.S. treasuries to foreign investors, investors like China and many other countries across the world. This has helped the U.S. government fund continuous annualized deficits for the past 2 decades. Case in point, it has been one of the easiest ways the United States has been able to get funny money into the hands of the government and prop up a lot of different stimulus programs, fund military budgets, healthcare entitlements, you name it. Things that really do, at the end of the day, have a major impact on the economy. How it's sufficiently spent or not, that's something for you and I to determine on our own, but not a conversation point here today. My major point I want to drive in, though, is that Arthur Hayes makes the argument here that we've been mainly relying on option number 3 and option number 2. Number 2, you're probably familiar with. The central bank can also print money and purchase debt. This is quantitative easing, right? When they're buying bonds from the government, giving them new money to finance their debts, their expenditures. And of course, the Fed holding on to those bonds. Well, newsflash, we're at a point here where the Federal Reserve is now starting quantitative tightening. They have to unload those treasuries on the market. And to make matters worse, like with every trade, they're not just, in this case, giving back treasuries on the market, they're trading those treasuries at the best available price for cash. That's removing cash out of the system, right? So again, this is basically and putting bonds in a really, really bad position. Not to mention, with foreign tensions growing, it might be that foreign and debtors, in this case, people who are, in this case, who are holding on our debt, right? Maybe they're not going to be buying bonds as much, especially with geopolitical tensions getting as high as it is right now in situations like Russia and Ukraine. The funding money that the U.S. depended on for so long, and other Western economies, and not to say that there aren't other governments that are in this seat as well, even goes to countries like Japan, who have engaged in excessive quantitative easing programs, who have depended on foreign buyers for their debt, now are in a pickle where it's a little bit of a Western showdown, right? No one trusts anyone anymore. And the Fed has now, due to inflation, been given, in this case, kind of the push to start quantitative tightening to end the funding money. And that's why the Federal Reserve is looking to raise interest rates half a percentage point, and yada, yada, yada. What does all this really mean? It means that as we go throughout the next few months and the next year, because of inflation, because of the distrust between countries, that treasuries and other government bonds across the world and the Western governments are going to be facing a major downturn. We are going to potentially see massive capital outflows, more than we've already seen here in the bond market, starting to shape up after a multi-decade bull market in bonds, a near-decade or multi-year bear market in bonds, where major amounts of capital flows are going to be reallocated in the market into something different. It may possibly go into equities, as sometimes they circulate between equity markets and bond markets, that capital flow. But it also might go into a new asset class that, as regulation is continuing to be worked out, new forms of investment in the asset class are becoming available. Perhaps we could see cryptocurrencies and, of course, its most predominant candidate, Bitcoin, take the stage. And I think that's exactly what, whether you want to call them institutions, larger private investors, whoever has that ability to buy Bitcoin right now, is doing at the moment. They're slowly but steadily getting their bags filled, getting their positions set up, and getting ready for the ride higher. That's at least how I'm perceiving it here. It's what the market data is showing us, right? There's no way really in this case to lie at this kind of scale here. We can see that there just simply isn't that many people willing to sell Bitcoin at the current market price, whereas there is a lot more buyers here. As you scan out the order book, it's a near 2x. A lot more people who are ready to buy Bitcoin, whether in the short term or the long term, versus those who are willing to sell it. So, now if you are like many other people, including myself, who are focused on the long term, if you guys are focused on placing that big bet, and the last thing you want to have to deal about, whether you trade the intra-market cycles or you're someone who's actively trading from one coin to another, if you're worried about taxes, I feel you. Tax season can be an absolute pain. And that's why I recommend, if you guys haven't checked it out already, that you check out today's sponsor, iTrust Capital. Now, iTrust Capital has been one of our long-term partners here on the channel, and they focus on offering crypto IRA products. Crypto IRAs allow you to both invest passively, but also trade actively in your IRA account tax-free. So you don't have to worry about taxes at the end of the year, and you can maximize an annual contribution of around $6,000 to $7,000 each and every year. Now, the really cool thing about a crypto IRA, in this case, especially at Trust Capital, is that it not only comes with the tax advantages, but that ability, in this case, to be able to invest and trade 24/7, to get in and out of the market if you want, without having to worry about the tax obligations. And on top of that, there are no setup fees or monthly fees. You just simply have a 1% transaction fee. And you can get access to all the cryptocurrencies we talked about here today, from Bitcoin and Ethereum, down towards a whole range of different DeFi altcoins, layer 1 protocols, you name it. So if you guys are interested in getting access to iTrust Capital, if you're interested in doing the smart thing, which is maximizing that IRA contribution and planning for retirement, I think not just myself, but the vast majority of financial experts will tell you it is the best thing to do to maximize that contribution for the average person, in this case, to max out your IRA contribution each and every year so that you can start to build that nest egg for your future. So if you guys are interested, check out the link down below in the description to iTrust Capital, and it'll give you great access to being able to plan and invest for your future. Now, last but not least, guys, I just want to go ahead and close off this topic here because I want to go back to the noise a little bit here. We've talked about the big macro picture. You guys see now why I hope, in this case, maybe just to summarize it, we can talk about that. I believe that there's going to be a continued mass exodus out of the bond market. And I think that while equities may eventually rebound, I think they're going to continue to correct for a little while. I think they're going to get down to the 20-30% pullback range and maybe even have a little bit of a worse sell-up, maybe even down to the 40-50% range, right? No matter what happens in those two markets, I think as this capital flight is happening, that there is a new asset class that is going to come out on the scene. And when I talk about on the scene of assets, in this case, we're talking about trillions of dollars, I'm talking about cryptocurrencies. Crypto right now is a little under a $2 trillion market. Equities is a $120 to $100 trillion market. Bonds, about the same league, if not a little bit bigger, when you're talking about all global debt. If you think about which market has the ability to 2, 5, or 10x over the next decade, I can tell you it's not going to be equities. It's not going to be bonds. And we're talking about in real terms here, right? If you divide it by the money supply or factor in inflation, crypto is the only asset class that is going to do this. Crypto is the only asset class out of these that doesn't have ETFs, that isn't right now permitted to be within the vast majority of pension funds or major funds that traditional Wall Street types invest in. But it's a matter of building in those positions before it happens. Buy the hype, sell the news. Ride the next potential wave before it actually happens. Get ready for the next move. That's what institutional money has to do. And they have to do it very, very quietly, because if they just market order buy, they're going to start to expose the truth of the matter, which is that right now we are seeing a significant trend reversal in the bond market and a new potential bear market in equities. And something else out there, whether it's crypto or gold or silver, has got to give. And I think crypto is going to be the answer to it. But could be wrong. Who knows? My opinion is one of many out there, and it shouldn't be the only thing you guys take for granted when it comes to investing in your financial future. But whether you agree or disagree with me, let's just say it may not be bad to have that exposure to crypto, to have some degree of exposure in case the doom loop, as Arthur Hayes puts it, happens, where a major amount of distrust comes into the bond market, into local currencies of governments, and instead opts in for a new asset class that doesn't really require that much trust, if any at all. So have a great day, guys. If you like this video, consider dropping a like, consider subscribing, and if you've lasted this long and enjoy me rambling, consider hitting that bell icon so you don't miss another upload here on the channel. That being said, my name is Nicholas Merton here at DataDash. Thank you all for tuning in as always and giving me some time out of your day, and I'll see you all in the next video. Take care, everyone.